see what my email is. Because some people laugh when they see my email. I'm like, what do you expect? I made it like 10 years ago. What do you want from me? Am I logged in? I don't even know. Yeah, I am. Okay. So, if you guys have never seen this website before, it's actually a really solid website. Okay. Now there's a lot of stuff that you can do. I don't have a paid membership to bar chart. I don't really care about their charts so much, but what I do care about is open interest, which you can get on bar chart for free. They do have COT. I don't really look at COT like that. And then they have options prices, and that's where back testing gets really fun. If you're ever able to back test some options, which of course I want to do with you today. So it's not really stuff that I got to do in the past, but on YouTube we can do whatever we want, and that's exactly what I'm going to exercise. So what I posted for you earlier today on my story. Now, if you didn't see it, that's okay. But what we're going to do is we're going to come over here to options prices. Matter of fact, let me see if I can turn this on. Okay, you guys can see. Thank you. Thank you for that. I appreciate it. So again, this is barchart.com. I'll put that in the chat just so you know. Okay. It's www.barchart.com. I'll pin that so it doesn't get lost. When you come here, you can search for a symbol. I search for SPY. Okay. SPY. SPY. Literally. All right. Now, you might have to log in to get the options prices. That's okay. You can make a free account. Again, you do not have to have a paid subscription with them. I don't have a paid subscription with them. And so there you have it. Once you find SPY, I'm going to come down here to options prices. Okay. Now that's going to give us a lot of shit to look at. It's going to give us all this stuff. You're going to have a whole bunch of various expirations. Now SPY is super liquid, so there's going to be a bunch of stuff here. I mean, weeklies, dailies, monthlies in here. Well, I guess dailies not really, but bunch of weeklies, okay, that expire on a bunch of different days here. All right. Now you also have, you can show all, you could only show like a few, and I don't even know what the fuck that even means. So that's great. But what I was referring to was specific. So if you look at, so today's the 20th. I think on the stream, or on my not my stream, I think on my Instagram, let me check real quick. Let me check one thing. So this was the 620. Okay. And we were, okay. So what I was telling you about was the 440 put. Okay. Now, again, look, if you're lost, just bear with me, please. Okay. Just bear with me. Trust me. I told you guys last week about the SPY 440 put. Okay. So that means what we're doing is we're not looking at calls because we expected the market to go lower. We're looking at puts because that means we're able to potentially make money if the market goes lower. Okay. So we're looking at puts, and it was the 440 put, which means we're going to come all the way down here to where it says 440, which is here. Okay. So that's this one right here. Now, it was up, like the high of the day actually was like 475. It's back down to 2, which is interesting, but that's okay. If we can go over to, so 440 option chart, Excel spreadsheet, we won't have to be dealing with this bullshit. Okay. You know what? This will work. This will work. But let me see if we can get a 15-minute chart. Okay, that's fine. All right, so take a look at this. Now, what I used to do when I first did a lesson like this is, I think it was with Walmart options. And what I did is I think I overlapped the chart, or I did like an Excel spreadsheet where I showed the chart and the options prices at the same time so you can see. Now, this is going to be really hard if you're not paying attention, okay? Like, I normally don't ask for your attention, like undivided attention, but trust me, you're going to need to pay very, very close attention here, okay? Now, watch this. When we go to SPY, okay? Now, for some context, I do need to put the tweet on here, so just give me a second for that too. We'll probably make this a video as well, because I'm probably going to teach you some things that I doubt anybody else is really teaching. You know, everybody can teach like, oh, smart money this, smart money that. And that's fine. But there aren't very many people that are really teaching options out there. Not like this way, at least. So the reason that this is important is because of the timing. Okay. So watch this, because I need to be realistic. All right. I'm not going to tell you like, oh, this was optimal. You know, you would have shorted the high and exited at the low. Like, I'm not saying that, but I do want to give you something that is realistic. Okay. So it was 9:42 on June 16th. 9:42 on June 16th. 9:42 on June 16th. It was about $1.37. Okay. $1.37. I didn't buy it at that. I bought it lower than that. But $1.37. Okay. Now, if you're taking notes, this is what that means. An option contract, okay, is for 100 shares, essentially. So you have the right to buy or sell 100 shares. So what you do when you calculate the price is you multiply this price times 100. Okay. So what that means is $1.37. What that means is if you wanted to purchase that contract, it would cost you $137. Okay. Now, because and this is the reason why I'm doing this. All right. Not just because I show you the versatility of when you understand price, you can trade whatever you want, which I've been saying for years, but it's to show you that you don't need a lot of money in order to trade, especially options. Okay. Now understand options are really, really risky. Okay. You got to know what you're doing, but this is why I'm trying to help you out the best way that I can. All right. So what I'm saying is if you bought that, like say you just saw my tweet and you didn't even bother looking at the chart. You just said, fuck it, I'm gonna buy it. $137. Okay. That's your total risk. The market goes, let's just say I was wrong and the market kept going up. That option would expire worthless. So you would lose that $137. Okay. So the risk is built in when you purchase an option or whatever. I'm not going to get into all the details, but just for like basic calls and puts. Okay. So that means this put option would cost you $137. Okay. Now around 12:45, it went down to 60. Okay. It went down to 0.60, which means that option contract is now worth only $60. So in a couple of hours, it was 137. Now it's worth 60. Okay. So yeah, you would have at that time in, I think 3 hours, maybe a little bit less, you would have been in drawdown by about $60, maybe $70. Okay. Now, by the end of the day, it was worth about 133. So if you went into the close on Friday, you probably would have been roughly at break even. Okay. Now, this is the part I'm trying to show you why options to me are worth trading. Okay. Now, I didn't hold, full disclosure, I didn't hold over the weekend. 3-day weekend. Market was closed yesterday. I'm not holding into that. But look at what happens today. Remember, multiply the price times 100. So let's just say you bought it when I tweeted dog shit entry, $137. Okay. This morning, what's it do? It runs all the way up, and this 15-minute candle closed at 470. That means $470 per contract. Okay. 130 down to 60. Over the weekend, we open and rally up to 475 or 470. I think we peaked at like 490. So when we talk about risk reward, right? I mean, you could have even averaged down, which again, if you ever trade options, I don't usually recommend averaging down. Okay. But we went from 60 to 470. Guys, that's pretty awesome if you ask me. Anybody who trades Forex, I mean, especially futures, my God, futures, you gotta have some actual bread. Okay. Well, E-mini at least. Micros, you only have to have like a couple grand probably, but E-mini, I mean, you gotta have you gotta have thousands and thousands of dollars. But options have a very low barrier to entry. $100, $60 that ran to 400 and some change. You didn't even have to capture that whole move. You could have instantly gapped to 250, 300. And I can guarantee you some people would have went, oh shit, I spent 130, maybe even 150. Maybe your entry could have been super hot dog water. $150. Bam. All of a sudden, the next trading day, it's worth $300. That's $150. You essentially doubled your money, even on a dog shit entry. Okay. And then you would have been probably pissed off that it ran up to over 400 and then 450. But this, to me, I believe is the volatility. It could be a volatility premium. You know, I'm not an expert in options. I'm not going to ever tell you that I know everything about options because I absolutely do not. Okay. Fuck. I don't even know what some of the Greeks do. Okay. So full fucking disclosure. All right. If you're an options educator, you're probably looking at me going, what the fuck? All right. But what I'm trying to point out to you guys is that right here, we went from the hundreds, you know, roughly 100, maybe down to 75. That ran up to over 400 overnight, over the weekend. So this idea of, well, you know, I don't have a lot of money to trade. You don't have $100 You don't have a couple $100 to put into a huge risky account like that. That's a banger right there. Now look what happens though. Look what happens when your timing is off. Okay, if you thought on the 15th, so that was Thursday. If you shorted on Thursday, you would have paid anywhere from $300 to $160 a contract. And the next day it went down to 60. Okay, so think about that. That's some huge drawdown. You know what I'm saying? So I'm telling you, options can pay very well. They can, but they can also really rip your face off if your timing is not great. Now, this was a short-term contract, okay? Because this expires today. All right? This expires today. And we were trading that essentially on Friday. Now, if you had a little bit longer term objective, then the whole math calculation would be different. But this is the date, time, and directional specific. So it's for the 20th of this year, below 440. Okay? Very specific. But do you guys understand what I'm trying to portray to you? Look at that. From $100 up to 400, almost 500. That's a 1 to 4, 1 to 5 just over the weekend. And that's per contract. So think about that. $100, you could have bought 2 contracts. All right. So that would have costed you 200 and you would have been able to sell it today for over 800. 900 given a specific exit. $200 risk for $900 gain. I mean, some people don't even make that in a week. And this would have been done over the weekend. 3-day weekend, really. Like, bro, that to me, if I was a beginner, if I had like no money, if I had like maybe $1,000 to my name and I was able to at least learn the skill set of trading, low risk, high reward setups, I'd be all over this shit. Because I can comfortably, if I was a beginner, I would be able to comfortably risk $100, $150 on a trade for it to go into the hundreds. Oh, hell yeah. Hell yeah. Bro, DeFi, yeah. Yeah. I mean, you can see it in the math. I mean, if you spent $200 on a contract and it went down to $60, I mean, bro, that's some serious drawdown. You know what I mean? Like, that's why you never put the farm on it. But every once in a while, you pick the right direction and the right price. This is what it does. This is what is available to you. When I was like this video. Oh yeah, appreciate that. Yeah, drop a like if you guys got some value. Because since we are looking at puts, this is essentially going to be the inverse, okay? So what I'm saying is, you see how when it was the 15th, or excuse me, the 16th, sorry, the 16th, right? Where we dropped lower and then today was doo-doo, right? Well, up until right now. But that whole drop down today opened and then that continued lower. That is seen here, right there. Okay. But now I can hear the ducks outside. They're screaming that it's fucking hot. And I get it. It's 94. I understand. So now that we've pulled back some though, right? We pulled back from, let me look at the chart. From 435 up to 438, closer to the strike, because this is where the strike price is at, 440, right? So when the market went our direction aggressively and violently, then yeah, the option was great. But now that the market is trading back up near the strike price, the options contract is losing value because it's getting back closer to the money. Does that make sense? So it's an inverse. The price is going to go up when we want the market to go lower for a put option. Okay. So hopefully that doesn't, I know it can be confusing. I didn't understand this shit for a long time. Okay. Trust me. When you first get into it, it's like, why even do it? But hopefully I've explained enough. It's just with the options though, it's going to be a lot more volatile because you have the Greeks to mess around with. Delta, theta is time decay. Data is certain movement for every $1. Like, I don't know. Again, I'm not an expert. I can't tell you every minute detail about options. Okay. I just can't. I don't know it. But there's that up movement, right? So that small pullback here is what led to that big pullback over in the options chain. Okay. So that's why entries and exits matter. But would you really let a $100 contract go up to $400, $450 and then not take profit or not take partials? Because here's the thing. Because this is what I learned about NFTs, okay? What my people have told me, right? They taught me, Siva, Jordan, Zach, you know, they taught me a few things about NFTs, all right? And they basically said, look, if you purchase, let's say 4 NFTs, right? And then those NFTs go up in value, and let's say you sell 2 of those NFTs to now break even on your investment or whatever. Now you have 2 NFTs that are risk-free trades, right? So it's the same idea, let's say in options. Let's say you bought one at 100 and it went down to 60 and you went, okay, well, I'll buy another one at 60. Okay, so you're in on 2 contracts at $160 total. Okay, so when it opens at 250, you can sell one of them for $250. So now you got your 160 back plus 90 bucks. So now you got your money back plus 90. And then now you have one more contract that runs for 400, 450. So you could always do that too. If you can take multiple contracts. Now, does it make sense? A little bit more sense, like why you would want to trade options? Break even, and then let the other one or two run. You don't have to put the farm on it, okay? You could say $100. Okay, cool. Well, I'll buy 5 contracts. Okay. Then you could have got rid of 1, 2, or 3 and held the other 2. It's all up to you, man. But I'm showing you the lowest barrier to entry. One contract, $100, maybe $60, ran up to over 400. I mean, guys, look, if I was dead broke or just a couple $100 to my name, this would mean a lot. You know what I'm saying? That would mean a lot, because guess what? $300, $400, that's groceries right there. You know, that's realistic. That's realistic. Groceries or gas or an electric bill. Shit. An electric bill in Houston right now? Shit. That's blessed, man. And that was just one of many opportunities. All right. So anyway, that's what I wanted to show you. Okay. So that's how you backtest options. All right. But remember, it's date specific, directional specific, and price specific. That's what the strike price is. So what we just witnessed was the 440 contract. Okay. So that means when we purchased this contract, it was out of the money. It was somewhere in there. So that's why when the market went up here, it went from $100 down to $60, because options, there's a whole plethora of reasons why options are calculated a certain way. And it has to deal with probabilities, right? The further out price is from your target, the less likely you are to get it, right? So like, say for example, right way up here at 443. If you were looking for sub 440, it would have been really cheap to get put contracts up here because it's so far away from this. Does that make sense? And that's why I'm trying to teach you guys. If you remember, if you've been following along with JP Morgan, right? When we were looking for 445, which we still haven't gotten yet. Hopefully we get there soon, because I'm getting really bored with this shit. But like, let's say down in here at 128, 145, that's a Hail Mary away. That's a whole Hail Mary away. So by like mathematical equations and stuff, they would say that the chances of getting to 145 is very, very low. Right? So I don't know if we'll actually be able to look at that today. Let me just see if they have it. So it would have been, I mean, if it was me, I would have went deep. Like 9, maybe 10. We'll do 9.15. And what do we say? 145 call, which is this one. Right? Is that right? Oh no, 145. Sorry. I'm tripping. Okay. So 413. That's obviously right there. Okay. So look at this. 413 was the day prior to earnings. Now, we weren't on YouTube at the time, but I still had a channel, my last channel. Okay. Rest in peace. We talked about how smart money was accumulating down here. I gave that to you because I told you to watch the earnings on Friday. Okay. So watch this. The 145 contract, which is the equal highs, above that actually. Okay. We're at the 128s, right? So that option contract would have costed you about $300. And it's fairly expensive. And I mean, it depends on what you think is expensive or not, but $300 heading into earnings, that's probably not the best thing to do. Okay. But look what happens the next day. When it opened at 500, went all the way to 600. On the 17th, still about 600. On the 18th, it went up to 700. Okay, so from 300 up to 600. Now, given that 145, it hasn't been traded to, and given probably the time decay and all that, it has come back. Okay, so I probably would not trade it right now, but do you see what the volatility premium can do given that big run here from the earnings? So look how price, right, has been rallying. It's been rallying to an extent, but the option contract hasn't really done anything. It's been rather stagnant. So that's why when I've always taught about options, almost every single time the market gaps into my favor, I almost always TP. Almost always. Because if the market doesn't do anything, if it goes lower or just consolidates, your option is going to lose value. Okay. But there's that. Okay. Now that's specific again to the September 15th. Now you can go in here and you can spend all day on this shit because you don't have to just pick September 15th. You could have said, well, John, that was April. You could have went with something closer, let's say 721. And the 145 call. Let's take a look at that real quick. Because I have no idea what this looks like. That's why TradingView charts are so much better than this ridiculousness. All right. So that week of earnings, we basically huddled around 160. Okay. So we'll just say 160 bucks going into earnings. 300, it opened, ran up to 400. 2 days later, it's worth 500. So from $160 to, we'll just say 400, 450. That's not bad. That's not bad. Now, given the market hasn't gone to 145, the strike price, look where it's at. It's back down to the $200 range. All right. Volatility premiums, earnings. Okay. And it has to go above 145. But I usually don't hold contracts to expiry. So I just don't do it. I just trade the options just to trade the options. Okay. But hopefully you guys see why options are pretty dope. Okay. Be able to capitalize on movements like that with very little money. Okay. Because in order to make that same, what do we say, 500 or 300 bucks, you would have had to hold $3,000 worth of stock for a few days. So think about that barrier to entry. $3,000 in stock or $150 option contract. You hear people say all the time, oh, you need a lot of money to make a lot of money. No, you don't. No, you don't. A 10% move to get $300, you would need $3,000 worth of stock, worth of shares. Or you could have had an option contract worth $150 that ran up there after earnings. So whenever you hear somebody say you need money to make money, just backhand them across the mouth. Just kind of bat. Okay, just do something like that. Just tell them you don't know what you're talking about. All right, just do that. Just go, you're an idiot. Don't do that. I don't condone violence, all right? Just try to have some fun, okay? But yeah, 2020, you can rewatch this many times. So now you understand what I look for when I say, hey, I'm long McDonald's. I'm long JP Morgan. I'm long Wells Fargo. I'm looking to short SPY. Now you know there's a whole other world out there. A lot of people don't even know all this shit goes on behind the scenes. People just think, oh, you got to buy a bunch of stock and then sell a bunch of stock. No. That's not how this works. No. Options are leveraged, man. Highly leveraged. That's why it's dangerous. And I've never not told you that. There's risk involved in trading. You guys know that. But it's with any leveraged instrument, it's volatile. All right. Wells Fargo pulling back a little bit. That's okay. JP Morgan is kind of just dancing around. But it looks like it's still heading there. Again, we got to give it some time. No rush. No rush.